Hello, and welcome to another episode of Get Your Fill, Financial Independence and Long Life, where we discover and ferret out ways to achieve those two goals. And today, I am very thrilled to be joined by Chris Odegard. He is an alternative investment blogger, which means that we're not going to be talking about like what everybody else is talking about, how do you make your money make money. And he's an educator. He's an author of this book called Get Off Your A $, which if you look at it quickly, could potentially spell something else appropriate, and Manage Your Money, why you need alternative investments. And he's got a blog at theprolificinvestor.net, and you can get his book there. And he shows investors why alternatives are vastly superior to the stock market and the 401k highway to mediocrity, which, right, if you know that if everybody else is driving the same way, that it's not going to be very exciting. Chris, thanks so much for being with us today.
Oh, it's my pleasure. Thanks for having me on, Christine. I'm really looking forward to it.
And this is such a perfect time because I'm actually in the middle of selling my house and I'm considering alternative investments. So
There you go. There you go. Yeah.
we can work on my, personal issues right now.
Absolutely. Might as well take advantage of the time, right?
Right. Exactly. So Chris, is this something that you were always interested in? Was this like your dream as a 10-year-old, or did something like exciting happen to kind of get you pointed in this direction?
No, it was not. It was not my dream at all. I grew up, a child of employees, that worked for a company, they got a degree, went to a company and where there were benefits and they worked there forever. And then they, retired at 65 or 75, whatever. So that was me. And that's the only, so I was a conventional investor. That was the only thing I knew. So I got a degree and worked for a company, and I worked there for a long time, and I put money into a 401k. And just like probably the majority of people that are going to be listening or watching this. And then something happened in 2009. I lost 55% of my assets and thousands of dollars a month in my mid 40s, right? So
wow.
I've been on the 401k highway to mediocrity, as you say. And then in my mid 40s, cut everything in half, 55%, $1,000 a month. In my case, it was a divorce, but it could have been, people go through bankruptcies, divorces, whatever kind of financial setback for whatever reason.
Right.
And so that was a big, that was a big wake up call. And a friend of mine, kind of just coincidentally around the same time, said, "Hey, Chris, you got to read this book. There's this book, you got to read it." I bought the book and I set it aside, and it just sat there. And then one day I was on a business trip and I read it. Of course, the book was Robert Kiyosaki's Rich Dad, Poor Dad. And that just kind of was a lightning bolt. All these things I had never heard of, real estate and all the different types of alternative assets and taxes. And it's just a completely different way of thinking about money. So I started going in that direction. I was going to say as fast as you possibly could, but I moved in that direction as fast as I comfortably could. And there was a single family rental, and then there was a duplex, and there was all types of other alternative investments, notes, promissory notes. You can own people's mortgages, and all the way from ATM machines to private equity to apartment buildings to self-storage. And then 9 years later, I was kind of looking back, and now I was a pretty at that time, I was a pretty sophisticated alternative investor, and I started my blog at theprolificinvestor.net. And I thought, why do I have any credibility to write about this? I knew what my net worth was. I had a good CPA, and I had bookkeepers, and I knew exactly what I was worth. I said, gosh, it's too bad I didn't have all this together 9 years earlier when I got divorced, because then I could actually say, hey, I came this far. But then there was another bolt of lightning that when you get the divorce, the attorneys make you do an accounting of everything. That's the only way they know how to divvy up the
right,
pie,
exactly,
right?
How to split it up.
And so I had made up that loss and multiplied it many times over in 9 years and quit my corporate job. at age 56. Now, age 56 isn't remarkable in itself, but I think when 9 years earlier you had lost 55% of everything, and then I've made all that up, and I fired the man, as I like to say, and now I never have to work again if I don't want to.
Right.
And that I would not have been able to do that if I had continued to just be on that 401k highway to mediocrity.
So you can thank your ex-wife for that.
That thought has crossed my mind. I don't know that she would appreciate that, but yeah. Yeah. Well, sometimes things happen,
Yeah, everything happens for a reason, right?
Yeah. I mean, if this is a little off track, but if I was still married, would I have still gotten to the same point? I don't think so, for a handful of reasons, which are beyond the scope of this. Right? Yeah.
Yeah. It's need that brings out these, it's tests your mettle, right?
Yeah. So anyway, I started the blog, and now I'm just trying to help other people. Really, if I could keep young people from ever getting on that 401k highway, and if I could get some older people to get off, but this is just such a foreign, it's just so foreign, because we kind of come out of the womb, and the 401k is the vehicle, and everybody we know, our friends, our family, everybody that's working in your company, that's what they do. And I can tell you from experience that, 8 or 9 out of 10 people that I talk to about this won't change anything they're doing.
Right.
So, but that's probably the 80-20 rule. It's probably the same with everything in life.
Right.
Here's a better way, but it goes contrary to conventional wisdom, and so most people are going to shy away from it. But this is where the money is, and this is what the wealthy people do. But you don't have to be wealthy to do this. You just got to get a little smarter.
You just have to start.
Right.
And it's great. Like, you brought up a couple of excellent points. Like, first of all, this idea that, I know many people, even in their late 30s, who are saying, oh, I'm too old to start with real estate. I'm too old to do this kind of thing. I can't take on that kind of risk, thinking that there is no risk in the stock market, thinking that there's no risk with their 401k, when they probably have no idea what it's even invested in, right? It's just whatever the wealth manager, whatever somebody told them to do. But also the idea that, this is called get your fill instead of like fire, because the same thing, like what's the coup in retiring? You said, I retired at 56. That's not really a great deal. Well, if you were started at 21, you could have retired at 29, right? And so that would be over 30. But that it's the same thing. Like I said, well, I started at 50 with basically nothing, because I don't understand exactly how I got to be 50 like so quickly. But and then you're like, oh man, I have like $5,000 in the bank. What am I going to do now? Right. And a lot of people would just say, well, a lot of women would say, oh, I better go marry some rich guy, because there's not much hope for me. But there is, and you just have to start, and you just have to say, okay, it's good that you had that necessity, right? I need to find a way so that I don't have to work till I don't have to be a Walmart greeter at 75 years old. So what's it going to be? And out of probably boredom, you grabbed the book and read it.
Well, you said something interesting there about, and I always like to say, look, there's absolutely nothing wrong with working. And, there are people that work until they die because they love what they're doing. And if that's the case, that's great. But most people are working because it's a necessity and not a choice. They're working because they have things to pay for. So, and, I'm always I'm not sure what to say when people ask me what you do, because I am retired from the corporate world. But I am doing something else. So I call myself kind of semi-retired. I write articles. I've written a book. I do videos to try and, help educate people. And, if you look at the definition of retirement, it's to be taken out of service. And I feel like I'm far from out of service. But, where you want to get to the point where you can make work a choice instead of a necessity. And if you want to go out and do something, and it pays little to no money, but that's what your passion is, money's a tool, passive income is a tool that helps you make all those choices.
Exactly. And that's it. I mean, what is retirement, right? You have to retire when you have hated every day of going to work, right? You're like, oh my God, I hate my boss. I hate my job, right? Then you need to retire. Like, I'm just going to go land a beach, but that gets old, especially if you retire before you're 72 now. Is that like the goal? So, yeah, I know. What do you have to retire to get your full benefits? So you're right. Money it's just a tool. It's not the holy grail. It's just the tool that gets you to be able to wake up in the morning and do exactly what you want. So you can tell people, what do you do? I do whatever the heck I want.
That's funny you mentioned that, because there's a time when I even said it a little more boldly, I do whatever the blank I want, whenever I want. I love to say that, every day is Friday and every hour is happy, right?
Exactly. That's for sure. And it's true. You just think things, a lot of people who, when they get to that point where they don't have to think about money anymore, they don't have to wonder where their next dollar is coming from. They suddenly think, well, what can I do to give back? What can I do that I really enjoy? You could have just as well tell people you're an author, you're a videographer. You could, but it's just really, at the end of the day, it's, what do I want to do today? What do I feel like doing today? What's going to make me smile? Is it sunny out? Do I want to just go take a walk? Right. It's fantastic.
Right. Yeah.
So what is a typical day for you at work or at your vocation?
Well, typical day is I'm just recovering. Well, I had shoulder surgery in January. So today, my typical day is I get up and I go downstairs and leisurely have a cup of coffee. And I used to not watch the news, but there is some actual real news and things going on in the world that are important, other than just the superficial stuff that I don't need to watch. And then, so I have a leisurely cup of coffee, and I do my physical therapy so I can get all the range of motion back in this shoulder. Then I come up here to my desk, and I still have to, even though I'm not working, I do have to do some things to manage these investments, with taxes and bookkeeping and all that kind of stuff. And I write my articles and get on podcasts and try to get the word out about how people can get richer faster. So that's, and somebody asked me, well, how many hours a week do you work? And I said, I don't know, probably 15 or 20 hours a week,
That's funny.
So yeah.
But it's, I say, like, define work, I mean, I have an Airbnb, which I still most of the time clean myself. So I got up this morning and I, it's a couple days before when he checks in. So I'll just do a little light, I did some light repairs, and then, did a couple things I felt like doing, and then, took a walk, it's just like whatever you want to do, that's what you get to do. If you don't feel, if you have a day where you don't really feel like writing anything, guess what,
right,
go to the mall or go,
exactly. Yeah. And I love things with motors. I've got 2 motorcycles and a red Z06 Corvette. So those are always I've driven across the country about 6 times in the last 4 years. And so there'll be some motorcycle trips and some Corvette trips this summer. And I'm in South Carolina, where it's sunny a lot of the time. And so, and I moved here from Seattle last year mostly to get away from the weather. So I'm really enjoying the sunshine here.
Yeah, it's beautiful weather there. So do you help people like one-on-one, or is it more just, a one-to-many kind of thing where you're putting your words out?
Yeah. I do a little bit of both. So I'm trying to do a one-to-many thing, because I really avoid anything that resembles a job, which requires me to be at a certain place at a certain time. So I love to do the articles and the videos, and of course there's the book. But on my website at theprolificinvestor.net, I have a handful of things that way people can interact with me. One is there's a conventional wisdom quiz. So you can take this 10-question quiz and test your knowledge, and I'll give you my answers versus your answers. And there's also a coffee cup in the middle. So if you want to have a free 30-minute virtual coffee with me, you can sign up. And I set aside Thursdays for anybody who wants to do this type of thing and just talk about their situation. And people have asked me, would I do mentor them? And I've done a little bit of that, but it's not something I really, it's like a job, trading your time for money. And I'm happy to devote a certain amount of my time to doing that, just to help people. So
nice. So how would you define an alternative investment? It's just
yeah. So there's two broad categories. So conventional investments, your stocks, bonds, mutual funds, ETFs, anything that's publicly traded is a conventional investment. Pretty much everything else is an alternative. So that includes every subclass of real estate, single family rentals, Airbnb, warehouses, self-storage, apartment buildings. And so some other alternatives would be like notes. So, or if you were a private lender, cash valued life insurance is a great alternative investment. And Business equipment. I own ATMs all across the country,
Do
which is kind
you?
of an
That's
interesting thing. Yeah. So yeah, anything that you can't buy on or sell on the, and all the cryptocurrencies, anything that you can't buy or sell on the stock market is an alternative. And just to make it a little bit clear, then there's another division. There's like 4 asset classes. So there's paper, and that's everything that's in the stock market is paper, right?
Yep.
So, and then you have private shares of small businesses. So that's like private equity, those businesses. And then you have real assets like real estate and ATM machines. And then you have commodities like oil and grain and beef and stuff like that. And so these 4 asset classes, and when you go to a financial advisor and maybe you pay them to help you build this balanced portfolio, it's all within one asset class, the paper asset class. So you're really not diversified at all because you have no businesses, you have no commodities, and you have no real assets. So it's kind of it's really interesting that we've just been kind of duped into this whole conventional financial planning thing, which just, it produces less returns. There's no built-in tax advantages to most of that stuff. You can't borrow money, so you can't use leverage.
Right.
It's just, I compare alternatives in my book, alternatives and conventionals across 13 categories. And the alternatives, the only place where conventional investments have an advantage, it's that they're liquid, meaning you can buy and sell them quickly, which you cannot do with an
maybe
apartment
not for
building.
the price you want at that moment.
Well, that's true, but I mean, if you bought a stock and it was doing badly, you could unload it quickly at some price. If you bought a piece of real estate that's going badly, it's going to take you some time to unload that, right?
Yeah.
But the other thing too is you have control over the alternative. When you buy a stock, bond, or mutual fund, it's completely in the hands of somebody else. If you buy your Airbnb outright and things aren't going well, you can change the marketing strategy, you can change the price, you can upgrade the property. So you have control to some degree over the outcome of the performance. So anyway.
It's so interesting. A lot of the things you're bringing up, I teach like a class, which is called Real Estate Investing. Is it for you? I'm a real estate agent. I don't know if you knew that.
Yeah.
So, and we go through all those exact points, like if I've bought Apple stock and I don't like how things are going, and I call up the chairman of the board and be like, look, dude, I've been looking at this. You got to take your focus away from this and put it over here. Like, they'll be like, and how many shares do you own, lady? Like $500 worth? I mean, give me a break.
Well, first of all, you'll never even get that phone call through.
Exactly.
Right?
The person's I'm going to get to that person.
Right,
so you can't repaint the lobby. You can't, you know what I mean? You can't do anything to help yourself. Whereas when you have the asset in your hand, you have that control, and the leverage is another huge piece of that. Huge, right? And that's how it starts. If I want to buy $200,000 worth of stock, how much money do I need? And the people are sitting there going, "Is this a trick question? Like $200,000, right? Obviously." But if I want to buy a $200,000 piece of real estate, how much money do I need? Well, am I going to live there? Maybe I can get
30% of it, most likely.
Yeah.
Right? Yeah.
If you're not going to, live in part of it, right? I like people to start with a multifamily home, if they don't have anything, because then, right, 5% down all day long, you're in, it's
right.
Much easier than people think.
Yeah. And, it's and another one of these things is that, we come to think is debt as bad. Well, there's bad debt and there's good debt. Exactly. And so, and if you think there's a physics formula from way back in the day, force is equal to mass times acceleration. And if you change that into a monetary thing with the force, the end result being how much wealth you're going to accumulate is equal to the mass, the amount of money that you have. And we all run out of our own money. So when you can supplement that with other people's money in the form of bank loans or private lending, and then the velocity is, well, how quickly can you keep that money moving? It comes out of one investment and you've got it right back going. Exactly. But there's one article I did not mention which one it is, but where I say, you can't get rich without debt, because you just run out, right?
Exactly. Yeah, that's the way I say that is you can't save up to be rich. You can't. You just can't do it.
Yeah, and with today's, there's no there's no interest rates anywhere. So,
great time to borrow,
way,
that's for sure.
Yeah, yes. I mean, the one way you can guarantee that you're going to fail is, number one, by sitting on the sidelines. And if you're putting money in a savings account, and I did another article about stop storing money under your mattress. And I say, look, when you own your house outright with cash, that money, that's just, you might as well, that's no better than putting money under your mattress, right? Well, my house is increasing in value. Well, it's increasing in value whether you have 100% equity or 20% equity. So I'm a big favor of smartly taking that equity out, whether it's through refinance or for a HELOC, and putting that money to work. That's your money, and all you're doing by having a house paid off is making, well, it doesn't mean this doesn't work if it's paid off, but by having more equity, all you're doing is you're doing the bank a favor and making their loan safer. You're not doing anything for you.
Right, exactly. I know, and this is the thing, right? It's interest rates. People are like, oh, interest rates are going up. Well, what are they now? 4%. I'm like, 4%. My first house, they had come down to 13% when I bought my first house, from 18.
I was I was in that same area. Yeah,
we went from 3 to 4. Oh boy, it's almost impossible to make less on your money than 4%. So just take it out and do something with it, right?
Right. Yeah.
Yeah, but it's hard, like you say. I mean, and that's Robert Kiyosaki. He starts with that, right? Like good debt versus bad debt. Like, and people think their home is an investment. Like, oh, this is my investment. Well, what are you going to do when you sell that beautiful investment? You're going to go live on the street.
Right. It's actually the biggest liability that you have, because when you get laid off or fired or whatever, what's the biggest problem you have? It's the house payment. It's the biggest liability, right? So,
and you have nobody to help you pay that. Nothing, no asset, nothing can help you pay that loan. It has to be you trading your time for money.
Yep.
So, but why do you think it's so difficult, Chris, to get people to kind of embrace this idea, right? It's very basic. You can look at any wealthy person, that you can think of, right? Except somebody who just invented something. Like pretty much most of the wealthy people in the world, I've got these kind of investments.
Yeah. Well, I think in general, people are just resistant to change. It doesn't matter what kind of change it is. And sometimes people will ask me like, well, what's one thing, or what's one habit or principle or something that you've adopted that has helped you move down this road? And it actually boils down to this: it's not running away when I hear something that sounds too good to be true. It's like, because so if I tell people, well, I routinely make 25 to 35% on annual return on my investments. And people go, oh, well, that's too good to be true. It's got to be illegal or
must be a Ponzi scheme
or unethical, right? And they that's it. And I go, what if that is true? I would really like to be the guy having those kind of returns. So I run toward that stuff carefully, more carefully than I used to when I was younger, right? Because you can't get burned.
Oh yeah.
But I would have left millions of dollars on the table if I had run away from some of these things that I heard that sounded too good to be true. One of the most poignant examples is, when I decided to go down this path, like a lot of employee type people, I had a bunch of money tied up in what was left over in the 401k, right? and the typical company pre-tax 401k, you're investing in mutual funds. You're investing in a limited number of mutual funds. That's all you can do.
Exactly.
And the common conventional wisdom is that you can't take that out and move it over into kind of a self-directed plan where you can invest in anything you want.
Right.
So kind of a mentor of mine a long time ago said, hey, Chris, will your company let you do an in-service transfer? And my first question was, what's an in-service transfer? And he said, well, that's where your company, while you're still working and you're not 59 and a half, will let you take some or all of that money and move it out of the company's plan to a plan of your choosing. And I kind of laughed. I've been working at this company for 20 years. And I was like, if that were possible, certainly I would have heard of that by now, right? Well, guess what? I was wrong. And the company had a provision that allowed me to take out all of their company matching. And so that's what I did. And that kind of gave me a chunk of cash to jumpstart some of this. But if I had just said, too good to be true, guess what? I would have missed that opportunity. So,
And, a lot of people have never even heard of a self-directed IRA.
Yeah, right.
And have no idea that they can invest in something other than, for example, mutual funds, which have a huge load and are not really that great,
Yeah. And there's so there's kind of a self-directed IRA, and there's kind of a self-directed 401k too. And the 401k is better for real estate, because if you buy some real estate through a self-directed IRA and there's leverage involved, there's something called UBIT, unearned business income tax, and you could be taxed on the leveraged portion of the gains that are associated with that debt. So the 401k is a better tool for anybody who's thinking going down that path.
So I know this isn't your thing, but just explain briefly how that would work for somebody if they have money in their employer's account and they suddenly are like, all right, I'm going to do this thing. I'm sick of working for the man. I'm going to fire the man. I want to go do this thing. How could they go about that?
You're talking about moving the money with the pre-tax?
And even, how like a self-directed 401k kind of works.
Yeah. So so kind of the more common and maybe easier path is a self-directed IRA. So you would go up and Quest Trust is one of the ones that I used. And you go up and you set up that account. Now you've got let's say you've got a corporate 401k pre-tax, and you've got this self-directed pre-tax self-directed IRA. Then when you go to the company and you say, hey, I want to do this transfer, they're going to cut a check. And this is important. They're going to cut a check to that Quest Trust company and that account. You don't want the money coming to you. It's not the end of the world, but it's a little more problematic. And then the money just goes from your company's 401k to there. And then from there, you can use that to buy your Airbnb or as a down payment on something else. 401ks are company sponsored. So in some cases, you might have to have a business or start one. But my first self-directed kind of 401k was through a company that helped me set it up as a sole proprietor. So anyway, both of them are available, but the 401k's got some advantages.
Excellent. And then you're suddenly free. You have a chunk of money that you're free to invest in real estate, invest in other types of alternative investments.
Yeah, you've got a chunk of money and you sign the papers, and you sign or wire the checks depending on who set up your account. And yeah, I mean, there's only like 6 things that the IRS says you can't use that kind of, we call those qualified plans. I think you can't invest in race cars and alcohol and art and things like that.
All the good stuff.
Yeah, but there's only like a half a dozen things. Yeah. But it's the companies, it's the Charles Schwabs and the Fidelity and those people that deal in this conventional class because it's easy and it's very profitable for them.
Absolutely.
And so anyway, but most people wouldn't even know you had a choice, right?
That's it. And that's because the people who we're asking in many cases are not the people, they have a vested interest, and you don't necessarily know that.
Mm-hmm. Yeah.
Yeah. It's interesting. I don't know. So what kinds of things would you recommend? Like I said, you've been doing your thing, you've been working, and you've, feel like, okay, I've got, some money saved, I've got a decent amount, but it isn't, the way I like to think about it is a lot of people's retirement plans kind of require that they die at a certain point.
Before they run out of money, right?
Right, exactly. I'm going to, if I'm not dead by 75, then that's it. I'm out of money. I'm going to be living on the street, right? So passive income stream, obviously you can continue to live beyond that day. So what sorts of things, somebody realizes, oh gosh, my aunt, this happened to me. My aunt died at 105. So I'm thinking, okay, so if I want to live to 105 with the conventional wisdom, I think I have to have like, I don't know, 10 or $15 million in the bank, I think, right?
Yeah. So there's the whole 401k and the conventional wisdom is based on kind of like 2 principles. One is that you're going to build up this mountain of stocks, bonds, and mutual funds, right? And your diversified portfolio, right, which really isn't diversified. So you're going to have this mountain of mutual funds, and then number 2, then because these mutual funds don't produce any cash flow like real estate, you have to somehow generate cash flow to pay your bills when you decide you want to quit working, which means you got to take your little pick and you're just chopping away at this mountain every month. You have to sell a portion of that portfolio off every month to generate the cash flow. And the rule that financial advisors give retirees is something called the 4% rule, which says, okay, you can probably safely, hopefully sell off 4% of that mountain of stuff a year and not run out of money before you run out of life. So so a lot of the common question is, well, how big does that mountain of money need to be? And I think that's the wrong question. The question you need to ask is, how much annual income do I want to have in retirement? So let's just pick a number. Let's say we want to have $100,000 a year of income in retirement. That works great in some places in the country, not so good in other places. But if you take that 100,000, you divide it by 4%, that tells you that you need a $2.5 million portfolio. Now, and I say that the 401k retirement system doesn't work for 92% of the population. And the reason I say that is because only 8% of Americans will ever be millionaires. Right. And so only 8%,
2.5 million.
So less than 8% are gonna have 2.5 million. They say, okay, well, maybe we set our sights too high. Let's say we only want to have like $63,000 a year, which is kind of close to the median income. Well, you do that same calculation, you still come up with $1.75 million. So again, that only works for 8% of the population. Exactly. And what's happening now is that the financial advisors are finding out that the 4% rule isn't working anymore. It's more like a 3% rule or 3.2% rule. So if you take the same $63,000 and now apply the 3% rule, you're back up to 2.1. So we've got a system that doesn't work for 92% of the population.
Right.
It's the craziest thing ever.
You know. So. But okay, so let's say that I decide, okay, well, this isn't going to work. I'm not likely to ever, first of all, I don't know if I want to limit my retirement income to $100,000. And second of all, it's not likely that between age 50 and age 60, when I want to retire, that I'm going to be able to make $2.5 million by working for somebody. So what would you recommend that somebody do, like the day that they make that realization?
Yeah. Well, the best asset class out there is real estate. So, so there are there are really, I'll say, and this is going to be one of my next articles. There's really like, there's 4 ways, but there's only 3 ways to do it. So the easiest thing is you could go out and invest in a REIT, R-E-I-T, a real estate investment trust. But all you're doing is you're investing in a publicly traded, it's a conventional investment. Exactly. It's publicly traded
fund of real estate.
It's a company that invests in real estate. So you don't get any of the benefits of real estate when you invest in a REIT. So now let's talk about the real kind of 3 ways to do this. So you could go out and you could, like we say, in your own account, in your own name, or whatever corporation or LLC you set up, you go out and buy yourself, you go out and buy a single family rental, a duplex, a small apartment building, and whatever, and you may manage it yourself or have somebody else, but that's one way. And if you've got a lot of free time, then that's okay. But think about the person that's got a full-time or a full-time and a half job, then that becomes a little problematic. So then, and so we're stepping away in order of things that require less of your time. So the next step is there are what are called turnkey rental providers. And these are people that specialize in different markets across the country, and they will go and buy up houses that are good cash flowing properties for that demographic, and they will do the repairs that are required, or upgrades in a manner knowing that this is going to, durable stuff, because this is going to be tenants. And then they will go out and find qualified tenants. They will put them in there and put a lease in place. And then you come and they will property manage that. They do the whole thing. And then you will come in with either cash or bank loan, and you will buy what's called a loaded rental. And it is already up and functioning with a tenant and everything, and property management. And then And then the third way, and this requires most of the time, this is required for you to be an accredited investor, which means you have a net worth of $1 million, excluding your primary residence, or an income of, I think it's 200,000 a year as a single person and 300,000 a year as a married couple. Then you can invest in what's called a syndication or limited partnership. So that's what I do. And all I do is pick a really good syndicator, somebody knows what they're doing, and I wire off my money to them and sign some piece of papers, and I sit back and wait for the money to come back in. And I'll real life example that just happened. I had invested about $40,000. So I'm a part owner in an apartment building somewhere all over the country. This one happened to be in Atlanta. It was $40,000 from my self-directed 401k. And I think they owned that for about 40 months. And I got back a couple of small checks early for, $1,000 here and $1,000 a year. And then I just got the final payment from the sale of $73,000. And so that's about a 27% average annual return. And all I had to do was obviously pick a talented management team that's doing this, and then send them the money. And so those are so do it yourself, single family rental, or small, multifamily. 2, find a turnkey rental provider. And 3, if you're a accredited investor, find a syndicator. Now, there are some syndicators that allow non-accredited investors. There's not an easy way that I know to go find them.
Yeah.
You can't go on the website and say, but anyway, there are lots of resources. Some of them are on the resources page of my website. So those are the ways, and I didn't get started until my, mid 40s. And so it's never too late to start.
Absolutely. Absolutely. And I know right now, here, at least in Boston, real estate, we suspect, is kind of peaking out. So, sometimes that means you might have to hang on for a little longer or whatever. But in most cases, I think these syndicators are probably adding some value. So they're not, they're not just hoping for the market to go up. They understand the business. They're saying, okay, what can we do to actually add value to this and make sure that we make a profit?
And this particular syndicator they're a huge value add, and they do it very quickly. And it's just like a manufacturing machine. So they just go in, every apartment across the country has got the same paint, the same fixtures, the same everything. And they just come in and as fast as they can. But the people that have been in the apartment space for decades are saying they have never seen the type of rent increases that are happening last year and this year, and without even doing any improvements, excuse me. So there's just in certain markets, there's just such a demand and a supply imbalance that, if you listen to 20 people, you could get 20 different opinions, but there is a majority of opinion out there that we've got a little bit more runway in terms of years for this. But again, it's not the same in every market.
Right. We still have bidding wars here. We still have a lot. And I mean, I see them adding inventory everywhere, but apparently, they're all rented. So, or sold. So I guess I don't know where these people are coming from.
Well, and I feel
where
like
were they living before?
I feel like it's a little bit different in the single family space, because people can only spend so much money on a house. At some point in time, there's a point where people can't afford to buy because the prices are too high. And now you raise interest rates. It seems to be a little bit different in the apartment space, because you're just increasing people's rent by, whatever it is. And I suppose at some point in time that taps out as well. And an interesting thing is, apartment buildings are like going from best to worse in terms of condition, are rated like A, B, C, and D. So the syndicate that I use, we're kind of in the B and C class area, because what happens when the economy, where does the person that's in the A class building go that's paying $4,000 a month? Everybody moves down a notch.
Exactly.
So you don't want to, the philosophy is you don't want to be at that top, right? Because when people can't afford that, they're moving down, right? And out of
you want to be the bottom, because then those people are like, they're the ones that can't pay the rent at all. So
but during the whole COVID, the apartments across the country did very well. I've seen the national kind of averages in terms of rent collections and occupancy. And the company that I'm with was actually a couple points higher across the board.
Yeah.
So it was almost kind of, well, they had to adopt a whole lot of technology at a very fast pace with the COVID thing, and they were able to do that. And I'm sure some operators weren't and didn't want to, and those people sold. But the asset performed very well the whole time. One of the big differences is rent used to come, rent's due on the first of the month, and it came on sometime between the 1st and the 12th, for example. When COVID hit, it came in anywhere from day 1 to day 31 when people had the money. Yeah. And the syndicator that I use was very proactive in helping connect the tenants with all the different state, local, and federal money that's available so that they could pay. Well,
and that's why it's a huge advantage working with a big company. Now, if you owned a single, if you owned a home that you were renting out, or if you owned a multifamily that you were renting yourself, you don't necessarily have that. And the other thing that I think is an important point is pretty much if you are using a self-directed retirement account, you can't be the property manager, right?
Right. Yeah.
So if you're thinking, oh, I'm going to take my self-directed IRA and I'm going to go and, buy a multifamily home with it, you can't do that. You really need to have someone else who's in charge. So a turnkey or one of these syndicated situations.
I mean, the way I like to answer the question, if I was starting all over, in my 20s, and I knew back then what I knew today, I would have started, going to these turnkey providers and collecting single family rentals. Yeah. But you learn what you learn when you learn.
Exactly. Just be grateful you learned it all, right?
Yeah. And, the big, and my last article was on this topic, the big draw for 401ks is the company match and the tax benefit. And so that's why everybody, you got to do it. Well, guess what a single family rental has? So the company match is nothing more than OPM, other people's money.
Exactly.
So when you buy a single family, when you invest the 401k, you get the company match one time at the time you make the contribution, and you get the tax benefit one time in the year that you make the contribution. When you buy a single family rental, you get the company match every month for 30 years. It's called somebody paying off the principal of your mortgage, right?
Exactly.
And you get tax benefits every year for the next 27 and a half years in the form of depreciation. And when you do an example of a certain amount of investment and you get to use leverage, right? So when you're doing it,
exactly.
when you do some numbers, the company the match or the other people's money and the tax benefits of the real estate are almost 3 times more valuable than the 401k.
Exactly. But the thing though is that people think of it as easy, right? If you're going to do something else, you're going to have to learn something. You're going to have to do some investment. Like they take the money out automatically. I don't have to save it. And then they match it and all, it's so great. I don't have to do anything. Whereas I guess there's some little bit you have to do.
You definitely have to be smarter. You have to be smarter, but the benefit, you don't get something for nothing, right? So if you want to have a mediocre, if you want to live like a pauper in retirement, put your money in the 401k. It's easy. Don't learn anything. If you want to live like a king or a queen in retirement, get educated, start investing smartly, and then you'll have this great retirement. And when you have these assets that not only go up in value, but produce cash flow, you don't have to sell. You're just getting wealthier. The longer you live, the more your balance sheet grows bigger, and the cash flow, if you want to take it, you can. So it's a beautiful thing.
Well, and then the whole idea of a generational wealth, right?
Mm-hmm. Right.
I used to work with this guy. His grandfather was a smart guy, and he bought a big apartment building, and the whole family every so many years, I guess he had more than one property, but like 1 year that I was working with him, they refinanced. They did a cash out refi from to take some of the equity, and they were getting like, I don't know, $4.5 million or something ridiculous, I mean, that family's just like splitting it up, saving it, doing their thing with it. And that you just need one smart person in your family. You could be that smart person,
Well,
who sets
that's yeah.
your whole heirs for life up, for comfort.
Well, that's what we call infinite return. So let's say you've got a $1 million, apartment building, and then at some point in time you put $300,000 down, and so this apartment building over time is growing. It's increasing in value, and it's generating in cash flow. And maybe you've made the improvements, and you've made not only did the property get more valuable just because of appreciation over time, but you put washers and dryers in every unit, and you cleaned up the pool and the patio, and maybe you remodeled the units. And then pretty soon the property is not worth, $3 million anymore. It's worth $5 million. So you do a cash out refi and you get your complete $300,000 back. Now you have no cash in that deal, but it's still there, still growing, still generating cash. Now your return is infinite because you have zero in that deal, and you've taken that 300,000 and moved it off into the next. So you're making money in two places at the same time.
Exactly. That's what they mean by when they say put your money to work. Right?
Yes, right.
Send it off, give it a lunchbox, and get it to work. Right.
I think it was the book The Richest Man in Babylon, where the guy talks about send your money off and it comes back with friends, right?
Exactly. And then he sends his children off. Yeah, right. That's what he says. Yeah, absolutely. So Chris, this is awesome. I mean, our time is like flown by. I want to respect your time, but is there anything that you wish I would have asked you today that I didn't think, anything you really want to share that I didn't touch on?
I have had some investments go bad.
I guess we could talk about that.
When I've had performing and non-performing notes, I've picked up properties that weren't as advertised, and all I could do was minimize my loss. And in my early days, I invested in, private equity, which is just private shares of, private businesses. And I did too much of that and too few of things. And there's a couple of those investments that you're on the edge of, going bankrupt or maybe making it. So you have to be careful. But that's why I wrote this book, get off your dollar sign and manage your money, why you need alternative investments. Because my path was, one step forward, 3 steps back, 2 steps to the side. I thought, wow, if I were doing this over, I could hopefully guide somebody on a more efficient, straighter path and help them make mistakes. So it's, and because a lot of these investments are unregulated, they're not overseen by the SEC as our stocks and bonds. It's easier to get hooked up with somebody that's not, ethical and have things go horribly wrong. So that's just, but every investment has risk, but that can be mitigated by getting some knowledge and doing your homework. And unlike, like what you said, you'll never be able to call up the CEO of Coca-Cola, but, I can pick up the phone and call the person that runs this syndication or the businesses that I invested in. And so you get the chance to meet these people and get to know them. And, it's really all about, character and who these people are. So.
Yeah. And I would say that's what I'm sure if you said, well, why aren't you still making these mistakes? It would be, what questions to ask. You've got the experience now, and there's obviously no substitute with that. But it's not as if, my track record for the stock market used to be like, I would buy a stock and literally the company would go out of business. That was I was like, I just don't have a gift for stocks, and then, later on I found out it wasn't actually, it doesn't have to be a gift. Don't say I don't have a gift for, real estate investing. No, it's not a gift. You just need to learn, right? You just need to, there's somebody, in this case, we have Chris Odegard. There's somebody who has done this before and has written a book about it. And all you have to do is read it.
Right. And that's true of, anything. It's like, oh my gosh, what if I could just find somebody that's already done what I want to do? Well, they've probably written a book, or they have a website, or they will teach you. Right. So why go out and make all those mistakes yourself?
Exactly. If only there was someone who'd done this before. So Chris, how can we get your book?
Well, if you go to my website, theprolificinvestor.net, you can take the conventional wisdom quiz. You can schedule a coffee with me. There's a little flashing star right there. And if you click on that, it'll link you to the Amazon page where you can get the book. And it's both in paperback and ebook. And right now, Right now, the ebook is on sale for 99 cents. So
Woohoo, 99
depending
cents.
on
Okay, so
for
99
about the
cents to set
for
you up
about,
for your retirement. Hello, is that a
yeah,
good investment?
exactly. Yeah. So
Ridiculous. And a free coffee with a really pleasant person and, very, very smart and experienced. Awesome.
let's hope so.
Chris, thank you so much for sharing your time with us today. This has been fantastic. And I hope listeners, I hope it's made you think. I hope it's made you consider that there might be another alternative to work until you're 65 and dropping dead because you don't, you hated your life so much. I mean, to make a life that you can enjoy. And you get up in the morning and say, what would make me most excited today, right? Even if you just decide, okay, now that I don't have to worry about money, I'm going to become an artist, I'm going to become a school teacher, I'm going to become somebody that I don't have to care how much money I make, right? You can literally do anything you want and not have to care about how much money it's going to pay you, even if it pays you nothing, right?
I think it was Zig Ziglar that said, they say that money can't buy happiness. Well, he said, well, neither can poverty. So money makes things easier. It gives you a lot more choices, right?
Exactly. Exactly. Awesome. So listener, think if you don't want to get rich, or even if you do, think of somebody else who could really benefit from Chris's experience, because he is just, given us a wealth of great little pearls that you want to harvest.
Absolutely. A young person too. If you got a young person in your life, if you feel like you're too old or just can't change, but you've got a son or a grandson or a granddaughter, yeah, let them know, man.
Absolutely. Oh, that's a great point. That's a great point. Because the earlier you start this, the bigger that little, the bigger that asset is going to have grown. I mean, if you could do what you've done in 9 years, right?
Mm-hmm. What could you do over 20 or 30? I mean,
exactly. And then you've got the market cycles working for you. It's fantastic. Awesome. All right. Well, have a great week, everyone. And we'll talk to you next week.